If you never want to have to worry about money again and you don't want to rely on a job to get paid, there are 7 places you have to invest your money, and I'm going to go over all 7 of those places in this video. Being wealthy means your investments are making you enough money to pay your expenses, so you don't need a job to pay your bills. The problem is most people will say, just invest your money into the stock market. But what if you don't know what stocks to buy? Or what happens if the stock market crashes and now your portfolio gets cut in half and you were relying on that income to pay your bills? This is why you need to know how to invest your money smartly. Nobody can predict the future. No one knows what's going to happen tomorrow. But you want to be financially educated so you can be prepared for anything tomorrow. I like investing in real estate. I also invest in stocks. I also invest in cryptocurrency. But I also know that no asset class can go straight up forever. And the last thing that I would want to see happen is to be living off of my investments and then markets crash and now I don't have money to eat. So instead of trying to guess what the best investment is, you want to own the right investments. That way you can win in any economic situation. So if you want to stop worrying about going to work to get a paycheck, there are 7 places you want to invest your money. That way you can win when the economy is booming, going sideways, or crashing. Investment number 1 is cash flow producing real estate. When most people think about real estate investing, they think, I'm going to go out and buy this property for $200,000, which yes, it is possible if you do a little bit of digging. And then I want to go out and sell this property for $300,000. But that's not what I said. I said cash flow producing real estate. This is speculation. We don't know where the housing market's going to go tomorrow. Instead of trying to sell this property for a huge profit, when I talk about cash flow producing real estate, I mean going out and buying a property not for you to go out and live in, but for you to rent out to somebody else. So now you buy this house and now you're going to rent it out to a nice family. And maybe they'll pay you $2,000 a month in rent. Now this rent income that you're generating should cover your expenses. That includes your property taxes, your insurance, your maintenance costs, your management fees, because I don't want you to be the one that's unclogging the toilets at 2 in the morning. You want a manager who's going to handle all the day-to-day work so it can be passive for you, cover your vacancy expenses and your mortgage if you have one, and then put some money in your pocket every single month. So let's run some numbers. If you rent this property out for $2,000 a month, that means this property can generate $24,000 a year. But you don't get to keep all that money. You got to pay all your expenses. Remember the property taxes, insurance, maintenance, management fees, and your vacancy costs. Let's assume that those 5 costs charge you $10,000 a year. That means you are profiting $14,000 a year. And I'm going to assume for the purposes of this example that you're not getting a mortgage, just to keep it simple. If you're making $14,000 a year, the question is this a good deal or bad deal? And the answer is it depends. For me, what I like to look for is a 7% cash on cash return. Meaning for every dollar that I invest, I get 7 cents of cash flow without having to see any appreciation. So if I take $14,000, I divide it by $200,000, you can do it on the calculator, this gives me 7%, meaning this hits my threshold for cash flow. Some of you might say, well, Jaspreet, I'd be okay with 5%. Others of you will say, well, Jaspreet, I need at least 10%. This cash on cash return generally also goes hand in hand with risk. The higher the cash on cash return, oftentimes higher the risk. The lower the cash on cash return, the lower the risk. In the commercial real estate world, this number is called your cap rate. So if hypothetically you were able to find a closet for sale in Manhattan for $200,000, you probably wouldn't be able to rent it out for $2,000 a month. You'd be renting out for a whole lot less because the cash return that you'd be getting in Manhattan is much lower. You're not seeing 7% returns, you're seeing 1% returns, maybe 1.5% returns, because there's so much demand to buy in that area. Versus if you go into rural Idaho, now you might be seeing 10 or 11 or maybe even 12% returns because there's not as much demand, more risk, and you might have a tougher time finding a tenant. Now, real estate investing is not going to be for everybody, but the reason why I like to talk about it so much is because when you invest in real estate, you get 3 benefits. Number 1, you can generate this type of cash flow, which is a nice type of passive cash flow when you have a good property manager. Number 2, you own a hard asset, something that you can see, feel, and touch because I own the land, I own the building, I own the bricks. And number 3 is you get a ton of tax breaks. As an attorney who's not your attorney, what I can tell you is that real estate comes with the biggest and best tax breaks that our tax code has to offer. So even though you're making this money every single year, you can pay little to no money in taxes legally, which is why some real estate investors are making millions of dollars a year, paying little to no money in taxes because that's what the IRS says. Investment number 2 is the cash flow producing business. Here's the reality that most people don't want to talk about. In our economic system, the way you build wealth is about being an asset owner. If you live in a first world country like America, you have to be a business owner if you want to build wealth, period. Now, that doesn't mean you have to go out and start a business. This doesn't mean you have to go out and operate a business, but you have to own a business if you want to build wealth, because that's how our economic system is designed. So when I talk about investing in a cash flow producing businesses, I'm gonna break this up into 2 parts. One is the business you operate. This might be you actually going on starting a business, which is not for everybody. In fact, it's not for most people. And then the alternative is investing passively, which would be like investing in a stock that's paying you with cash flow. Let me break this down, but I want to remind you that if you are an investor and you want to stay up to date on what's happening in the financial markets, my team at Briefs Media publishes a free daily newsletter where we break down what's happening in things like the stock market, the housing market, the crypto market, the global economy, and our own economy into a fun, witty, and easy to read newsletter. It's completely free. We have hundreds of thousands of investors that are reading market briefs every day. So if you have not joined yet, well, I got the link for you to join for free down in the description below. There's a big difference between working in a business and owning the business. I'm an employee at Briefs Media. That means I'm entitled to a salary. But the owner gets the profits. I am also the owner of Briefs Media, so the profits come to the owner. If you want to get access to those profits that a business has, you have to be an owner. And the difference between an owner's profits and your salary is capped. It's capped based off of whatever your salary is and maybe whatever raises that you get. There's no cap on profits. If you own a piece of a company, you could have unlimited profits because there's no limit. The simplest and most accessible way to do this is just to take some of your extra money and invest your money into a company that's paying out a dividend. This means you're investing your money into a company that's making a lot of profits, and now when they have all this excess profits, they just give it away to the shareholders, people like you who own a piece of the company. So if you go out and you buy 1 share of, say, McDonald's, you become one of the owners of McDonald's. Now, you don't get to tell McDonald's what to do, although you do get voting rights, but you are entitled to your share of profits because you own 1 piece of the McDonald's pie of ownership, because you own 1 share. And because you have that, when McDonald's has this big profit at the end of the year, they give a big chunk of it away. In 2024, they gave away about $5 billion. You're going to get your piece of that. 1 share out of the many millions of shares that they give out dividends to. Now, not every company pays out a dividend, and I'm not going to talk about which stocks pay dividends in this video. I already made a video talking about that very recently, which I'll link for you down in the description. But instead, I want to talk about funds, because if you start investing in McDonald's for the dividends and then they start creating bad burgers and then they go out of business, you would lose all your money and you would also lose your future dividends. So higher risk, higher potential return. And for today, let's talk about investing in funds, because there are baskets of stocks called funds that you can invest in specifically with the goal of generating dividend income. I'll give you a few examples. NOBL, SCHD, and VYM are 3 different ETFs, meaning funds that specialize in investing in dividend-paying companies. NOBL is a fund that invests in S&P 500 dividend-paying companies. The S&P 500 is a group of the 500 largest companies in the stock market. Some of those companies pay dividends. That's what NOBL focuses on, but to take it 1 step further. They only invest in the companies that have paid out and increase their dividend every year for the last 25 years. So in order to be in this NOBL fund, you have to be an S&P 500 company, you have to pay out a dividend, and your dividend has to have gone up for at least the last 25 years. That's the companies that you invest in if you invest in this fund. SCHD and VYM are 2 funds that I am personally invested in as a disclaimer, and these are 2 funds that invest in high dividend paying companies inside of the United States, which SCHD is created by a company called Charles Schwab, VYM is created by a company called Vanguard. So if you wanted to invest in companies, into stocks that pay out dividends, and you don't want to try to find the perfect company, one alternative is you can invest into a fund. Now, I'm not telling you what to invest in. You got to do your own research because I'm not a financial advisor. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will lose money at some point. So you need to always do your own due diligence and never blindly trust a random guy on YouTube. Now, the thing you want to remember here is when you get paid with dividends, you're going to have to pay taxes. And so when you buy this, what you're essentially doing is every time you buy a share of any of these dividend-paying funds, you're buying a machine that's paying you with cash flow. Every dollar you invest is a dollar that's going to pay you with a little bit of cash flow. And then you have the opportunity to reinvest these dividends as well. Because when you get paid the dividend, many brokerages will allow you to just automatically reinvest that money. That way, now your money that your money made can make you more money. So you go to work to make some money. You take some of the money and you buy some cash flow producing machines. You buy some cash flow producing dividends. Then as you get that cash flow back, you can reinvest the cash flow to make you even more money. That way now you're working hard to create some more cash flow, and your cash flow is also working hard to create you even more cash flow. That way you can build this bigger and bigger snowball that's working to produce more cash flow for you. This is the passive way, and when you think about taxes, you have to remember that even if you reinvest that dividend income, you still have to pay taxes on it. Although the nice thing about dividend income is your tax rates are generally lower than the tax rate you would pay from your job if you earned that same amount of money, because the tax code incentivizes you when you make your money from your investments, and they kind of punish you when you make your money from your job because, well, when you're an investor, you qualify for lower tax breaks and higher tax rates. But it gets even more interesting when we talk about operating your own business. Because now, if you can build your own business, which I get it is not for everybody, you have the ownership of that company. And as your business starts to grow and you pay yourself a salary, well, remember, the profits that the company makes go to the owners. So if you own the company, you get to make the profits. But this is where also the tax code can be very interesting, because you as the business owner are allowed to deduct what's called ordinary and necessary expenses. So what's ordinary and necessary for your business? Well, if you have a digital business and you have to, say, travel to Hawaii for 2 weeks for business, maybe you have to have some meetings out there, maybe you have to record some videos, maybe you have to go out and look at some real estate. But if you have to fly out to Hawaii with your business partner, who happens to be your wife or your husband, now that flight to Hawaii is a business expense. It's ordinary and necessary for your business because you need to go to Hawaii. And while you're there, you need a hotel. And while you're at the hotel, you also need meals. And maybe you need to have some events that you need to go to. You can start to see how these things can become business expenses because it's ordinary and necessary for your business. I'm telling you this because these were things that were never taught to me. When I was growing up, I did not travel a lot. When I talked about traveling as a kid, most of the time it was just me going to India to visit my family. Well, as I started to see some success in my business, I started traveling a whole lot more with my business partner, who happens to be my wife. So there were times where we lived in California for a month because I needed to for business. I was speaking, I was doing podcasts, and I was doing a lot of stuff out there. I lived in London for a little while for the same reason. I was speaking, I was doing podcasts, I had meetings. I lived in New York for a little while for the same reasons. Those trips then became business expenses with my business partner, who happened to be my wife, because it's an ordinary and necessary expense from business. In fact, sometimes it gets even more wild because I remember one year my accountant calls me and he says, "Jaspreet, how do you feel about G-Wagons?" I said, "G-Wagons? Well, I don't know, I don't really care. What do you mean?" He says, "Well, I think you should go out and buy a G-Wagon." I said, "Why?" He said, "Well, the government has a program going on right now where they will give you a bonus depreciation, meaning a bigger write-off, if you go out and buy a heavy vehicle like a G-Wagon for your business." And I said, "Well, why do I need a G-Wagon for my business?" He said, "Well, you're an influencer. And because you're an influencer, you might need a G-Wagon to maintain your image as an influencer." I said, "Is that real?" He said, "Yeah. People are doing it all day and night long." Now, I did not go out and buy a G-Wagon because I'm not going to go out and spend money on something that I don't need just to save 30 or 40% in taxes. But you can start to see how the tax code can benefit you when you also operate the business as well. Is it more risky? Absolutely. Is it more work? Absolutely. But this is the game that wealthy people are playing. And now that you understand this, the question is, what are you going to do? Is it easy? No. But the opportunity is there. So now I've talked about investing in cash flow producing real estate for the cash flow and tax breaks. I've talked about investing in cash flow producing businesses for the tax breaks and the cash flow. Now let's talk about something a little bit different. growth, for more upside potential in your money and your investment. Investing in an established company like McDonald's is very different than investing in a startup company that's very young, because McDonald's already has the market share. And they're making these big profits that they just give away to shareholders because they don't have a better use for that money. A startup, on the other hand, wants to take all their money and reinvest it because they want to grow as big as possible, as fast as possible. They haven't established themselves the way McDonald's has just yet, so they are gritty, they want to grow, and they're willing to take on more risk. This is where you have the ability to see more growth in your stock price. You buy a stock for $100 and it goes up to $200. But it also comes with a little bit more risk because it's not as established and it hasn't built itself yet, but you can also see more upside potential. Now, a lot of people on Wall Street are going to have their own definition of growth. But for the purposes of this video, when I talk about growth, I'm talking about investing in companies that are focusing on fast growth in their stock price. And I'm going to break it up by talking about three different things: tech companies, growth companies, and more niche companies. So let's go over a few ETFs. Again, I'm not telling you what to invest in. I'm just showing you a few examples to help you start thinking like an investor. There is an ETF called QQQ, which invests and gives you exposure to the NASDAQ. The NASDAQ is a group of the 100 largest stocks that are not financial, which means most of the companies, not all, but most of the companies in the NASDAQ are tech related. So if you want to get exposure to tech, many people will say that QQQ is an ETF that can give you exposure to the broad tech area. And we know that in general, tech companies are generally focused on growth because they're always trying to innovate. But some of you might be thinking, well, Jaspreet, that's not exactly growth. What if I just want to invest in growth companies? Again, there are funds that specialize in giving you exposure to growth companies. For example, VUG. For example, IWF. VUG is an ETF created by Vanguard, which gives you exposure to growth stocks. And IWF is an ETF created by iShares, which also gives you exposure to growth stocks. What is a growth stock? Again, these are smaller companies that are focused more on the growth, that are not really working to make huge profits and pay out big dividends. They're focused on growing their share price. More risk, more potential return. Or we can get a little bit more niche and look for a specific industry that you believe is going to see a lot more growth and upside. Again, here are a few examples. VGT is an ETF created by Vanguard, which specializes in giving exposure to IT companies, IT stocks. So if you believe that the IT sector is going to explode, this is something that you may want to consider, or other ETFs related to it. QTUM is an ETF that gives you exposure to quantum computing. Quantum computing is believed to be the next technology after AI. It is an idea of creating chips that are infinitely times more powerful than the chips we have today. There are many companies that are innovating and investing in quantum, but quantum chips and quantum computing isn't readily accessible yet. If that's something you believe in for the future, this is something you may want to consider looking at. But again, we don't know where it's going to go. Higher risk, higher potential return. And then we have AIQ, which, if you couldn't guess from the name, is an ETF that gives you exposure to artificial intelligence. Again, there's been a huge run-up in artificial intelligence. Some people say it's a big bubble that's about to crash. Other people say it's just getting started. And so if you have a long-term mindset, you want to be an investor, and you believe that we're going to see a lot more growth, well, you have opportunities to invest into that niche through different types of ETFs. Again, my goal is not to tell you what to invest in. I want you to start thinking like an investor and see what the opportunities are. That way you can make the right decisions for you based off of what's right for you, your family, and your community. But we're just getting started. We've talked about investing in cash flow producing real estate. We've talked about investing in cash flow producing dividends, whether it's something that you operate or whether it's something more passively like a dividend paying stock or fund. We talked about investing in growth. But now let's talk about investing internationally, because if you see a recession in the United States, well, that could hurt a lot of different assets in the United States. But you could protect yourself by also owning assets in other countries. Take a look. If the United States economy enters a recession and the stock market goes down and real estate prices go down, that would impact your investments in the United States. But sometimes you'll see a recession in the United States while other countries like, say, India are seeing a big boom with their economy. And this is where you can see some real diversification, where if you own assets in India or other countries, well, that could benefit you during a time of downturn in the United States, because we know recessions happen, we know market crashes happen. In the last 100 years, we've seen 16 recessions and 25 market crashes. They're going to continue happening. So one of the things that you can do to make sure you win in all types of asset cycles is invest your money in foreign countries as well. Now, you might be thinking, well, Jaspreet, that doesn't sound very easy. I don't know anybody in India. How do I go out and invest in India or Brazil or China or one of these foreign countries? Well, again, there are funds that can make this very easy. And we can talk about this from a broad perspective and a niche perspective. From a broad international perspective, VYMI is an ETF that I'm personally invested in as a disclaimer, but this is an ETF created by Vanguard that gives you exposure to international companies, but more specifically, high dividend paying international companies. So this is an ETF focused on dividends, cash flow, but not in the United States, internationally in non-United States companies. Then we have VEA. This is another ETF created by Vanguard, but this specializes in investing in developed foreign countries. So more of the established foreign countries around the United States. This invests in companies in those developed countries. But then we can compare that to IEMG. This invests in the emerging markets, the smaller countries. So you can start to see the differences. If you want to invest in a more smaller country where you can see more growth in the economy and more growth in those companies, higher risk, higher potential return, this and other emerging market ETFs could give you access to that. If you just want to invest in more of the developed foreign countries outside the United States, ETFs like VEA can give you access to that. And if you want to invest in cash flow outside of the United States, VYMI and other ETFs can give you exposure to that. Again, there are many ETFs out there that can give you exposure to each thing. I'm just getting your brain thinking like an investor. But you can also get more niche. For example, INDA is an ETF that gives you exposure to, do you want to guess? Indian companies in India. EWZ is an ETF that gives you exposure to companies in Brazil. So you don't have to go into Brazil or go to the Brazil stock market to invest in Brazilian companies. You can just invest in an ETF like EWZ. Again, there are many different types of countries you can invest in. There are many funds for them out there. You just got to find what's right for you. Now that we covered how you can diversify yourself outside of your own country's economy, let's talk about how you can have a different level of growth and diversification in speculative assets, which is very different than everything else we've talked about so far. A speculative asset is also risky. This is something that you believe will go up in value, but there's a chance that it could just completely burn and crash. But because of your belief that it might go up in value, you can consider allocating some of your portfolio to this. Now, my personal recommendation, which take it for what it's worth, I'm just a random guy on YouTube, I can't tell you what you to do, is that if you're just starting off, you should have zero speculative assets. As you start to build your wealth, now maybe you can work your way up to 10% of your investments in speculative, and maybe as you start to really build more wealth, maybe 20% of your investment portfolio can be more of speculative assets, but I wouldn't do more than that. For me, my speculative assets make up no more than 18% of my investment portfolio, but take that for what it's worth. Here are a few examples of what I mean. Cryptocurrency is something that I consider a speculative asset, and I treat it like that in my investment portfolio. The startups that I invest in, I treat them like a speculative asset because I know that startups can go up in value very fast, but they can also go bankrupt just as fast, which has happened to me. Startups that I've invested in have gone bankrupt. Same with crypto. We've seen crypto booms and busts. So yes, it can go up, but it can also fall just as fast. A couple other examples are trading cards. I know a lot of people like to talk about trading cards as an investment and watches as an investment. These aren't things that I have personally dabbled into, but some people like to look at these as investments, and there's a whole lot of others, but this is all speculation. You're hoping that this thing will become more valuable. You're hoping that people will want more of this thing in the future, but there's no guarantee. It's high risk, high potential return, which is why I don't make it a big piece of my portfolio, and I don't like to see it as a big piece of other people's portfolios, especially as you're just starting off. We started by talking about how you can see more cash flow from real estate and businesses. Then we talked about how you can see faster growth with investments. We talked about how you can diversify your money internationally. And then we talked about how you can have a little bit more fun and have more potential risk for more potential return with speculative investments. But let's also talk about how you can protect your assets, especially during downturns. By the way, if you like learning this type of stuff, when you sign up for Market Briefs, you'll also get access to a free masterclass on how you can grow and accelerate your wealth. When it comes to these types of protectionary investments, for me, this is me investing in physical gold. I have about 2% of my investment portfolio in physical gold because the way that I look at it, gold is a form of real money. It is a form of hard money because gold has been used as a currency since before I was born, and it will continue to be used as a currency long after I'm gone as well. And so gold has really proven the test of time, and gold is used as a currency or has been used as a currency around the entire world. And my theory is that if I buried $10,000 worth of cash and $10,000 worth of physical gold in my backyard, My theory is that in 10 years, the gold would have more buying power than the cash because of inflation. Am I certain? Absolutely not. But that's why I own a little bit of gold. It's not a huge investment. It's only about 2% of my total portfolio. I don't look at it like a real investment. I look at it like a way of saving hard money. But that's my way of having a little bit of doomsday protection, a little bit of insurance against all of that. And what we've seen is that gold generally do well when you have economic chaos, when you have economic downturns, because when people are worried about a crash or a recession, they like to look for safer assets, something like gold. Now, the last thing that I want to mention about something like physical gold is that it's different than these other assets because gold isn't actually producing real value. When I buy gold, it just sits there and looks at me. Versus if I go out and buy a piece of real estate or if I invest in a stock, well, that stock, that company is working to produce value. They're working to produce bigger profits. They're working to produce a better product. The real estate is giving value to somebody who's using it or living in it. The gold is just sitting there. So that's why I don't look at it like a real investment, but I look at it more like a hedge, more of a protectionary asset. And every time I talk about this, people ask me, well, how do you actually invest in gold? I don't like investing in paper gold because there are stocks that you can buy that give you exposure to gold. You can invest in gold companies that mine gold. I like to own the actual physical gold. And there are dealers that you can go out and find, and they will sell you the physical gold, or there are platforms on the internet that you can buy fractional shares of bars of gold, and then when you buy a full bar of gold, they'll ship you out a full physical bar of gold. So you can do whatever you want, but for me, personally, I just like owning the physical gold as opposed to paper gold. And no, I don't keep the gold at my house, I use a vault. And last but definitely not least is investing your money into your own education. Now that can be a very vague concept, so let me break this down. When I talk about investing in your education, I'm gonna break this down in 3 tiers. Number 1, investing in your own mindset through your personal development. Here's the reality. The reason why generational poverty is generational isn't because it's in your DNA. It's because many times we're bred to believe the things that poor people believe. When you believe that money is bad, rich people are evil, that you can't afford these nice things, and you grow up hearing that, that becomes ingrained and wired into your brain. So then when you have kids, you say the same things. Oh, don't worry about having those nice things. That's only for other people. We can't afford that type of stuff. Oh, those rich people must have done something bad or evil. And you start to pass it down, and then that poverty becomes generational, which is why you have to rewire your brain. And this is where you can read books or listen to podcasts or YouTube channels that specialize in that type of personal development to build your mindset, because you have to become wealthy in your mind before you can become wealthy in your bank account. So please, if you have not read a personal development book before, read a few of them. See how you feel. Just try it. Number 2 is investing in your financial education. Once you understand that you have the ability to control the outcomes in your life, now you got to understand how money works. This is learning how investing works. How do you put money aside to invest? How do you systemize your money? How do you pay down your debts? And how do you actually build wealth? There's a ton of content on my YouTube channel when it comes to financial education, and then going even deeper on your research, because what you'll realize is as you become an investor, the better the research you have, the better the investments that you can make. And this is where you can do this on your own, and I would encourage you to try to do so. Try to keep up with shifts that are happening. Try to keep up with what types of investments you want to make. That way you can find the right opportunities for you. And this is where my team at Briefs Pro publishes and sells this type of research. Yes, we have a free newsletter called Market Briefs, but we also have paid content under our Briefs Pro platform where we focus on this type of investor research, where our analysts are doing this type of investor research every single day, and we publish a weekly report. Again, you don't have to go out and buy that. What I'm trying to get you to understand is that if you want to make smarter decisions, the better your research is, the better the investments that you can make. Now, of course, nothing is guaranteed. I mean, investing is risky, but if you have better research, you can make a more informed decision when it comes to your investments. And now with that, we talked about the 7 ways that you can invest your money. It does not happen overnight. This is not a get-rich-quick system, but this is a build wealth actually system if you're willing to put in the work, stay consistent, and actually do it. And with that, I would love to hear more from you. Would you like to see more videos on that personal development, the mindset side of building wealth, or more on the financial education side of building wealth, or more on the research side of building wealth? Let me know. That way me and my team know what types of content to create to make better content for you. This is how the majority of Americans statistically manage their finances. Let's assume that you make, as a household, $60,000 a year, which is $5,000 a month. Now, who's the first person that you're gonna pay? It's not Chipotle and it's not Amazon. It's the government. Because if you're working a job,